All right, guys, I have good news and I have bad news for you. All right, so it is a little bit warm still down here. The good news is this is a smaller class than my last one. There were 25 people, which I think was like every single chair was filled. It got really warm in here really quickly. So the good news is smaller group of people won't get as warm. The bad news is I'm going to be talking about auditing. So a lot of hot air is going to be coming out. So I apologize in advance for that. Before we get started, please make sure that you complete your beginning of semester questionnaires by class or by the end of the week. I don't want to shame you all, but my AIS class, they finished 22 out of 25 students had finished their questionnaires by the beginning class period. We have 17 students in here, and you guys are supposed to be the model example. You guys are the seniors. It's only 12 out of 17 in this class. All right, we're not off on a good start here. You know, if I have to use my AIS to shame you guys, don't think I'm above that. I will totally do that. Okay, but please make sure you finish that. It's obviously a small thing. As far as good news is, we'd have some people who are working ahead. Some people have finished the first ID assignment. I do want to clarify a couple things though. In submitting your ID assignment, please make sure you finish both chapter 1 and chapter 2. Okay. So we need to make sure to get both of those done. Good news is that the submissions are not due yet. So if you only submitted one, you have time to submit the other as well. Please make sure you get both of those done. And homework is also due on Friday. So we have regular homework assignment, which is really short. It shouldn't take you like 15 minutes to complete that. And then the ID assignment, which is also really short. Most of it's tutorial stuff. So you're looking at a grand total of maybe an hour, probably less, but just make sure you get that done. Today we're going to have one of my favorite lectures, and it kind of is unfortunate that we're doing it in this sauna. You know, it's not real bad right now, but like I said, once I get animated, you know, and the rhetoric starts flowing, then it'll get really warm in here. But I do enjoy this lecture. This is actually my favorite lecture for the semester. Yeah, I'm going to start this off with a semi-rhetorical question. What's your goal in this class? Okay, what's your goal in this class? Not to be shy, you know, you can say it out loud. I want to get an A, Dr. Barnes. Okay. Is that your goal? Yeah. Okay. See, I've done this before. I know the way this works. Okay. So your goal is to get an A in this class. What is my goal in this class? Your goal is to give us A's, Dr. Barnes. Yes. And no, is that my goal? Legitimately speaking. No, I want to teach you guys auditing, right? Okay. So we've kind of seen an issue here is that we don't have the same goals. Let's think about this a little bit more broadly. Most of you guys are going to be graduating. I say all of you guys will be graduating within a year or two. What's your goal after graduation? What do you guys think?
Earn money.
That's it. Yeah. It's not get a job, it's you want money. You know, if you could have the money without the job, I think most of you would do that. Can we say that that's the case? Okay. So what is your future prospective employer's goals? Is it to give you money? It's like, you know what, you're so wonderful. Let me just hand you bags of cash, you know. If you get a good job, it might feel like that. But no, is that their goal? They want you to do the job so they can actually get the resources that they need from you. Is that correct? All right. So what do we know about these particular questions right here? That there's an incentive alignment problem here. That we're trying to do same things in the same context, like we're doing this course together, but your incentives are not the same as mine. Can we agree on that? All right. So hold on to that because that's really, really important. We're going to have to talk about what that means here in just a second. So how many of you guys have heard of the concept of principal agent theory? Probably in finance courses. And so, so principal agent theory underlines what the importance of this particular course is. So if my slides will advance, I will tell you all about it. So principal agency theory, this can actually use multiple settings, and we will use it, but let's talk about it specifically with the setting of a traditional corporation. All right. Traditional corporation organizational setting. Who are the principals? The owners of the organization? Yeah, so the people who own the organization. How would you describe the principals of an organization? Are they people who are there all the time saying, run my business properly? You know, it's like, no, they're absentee owners. That's how they describe them in the corporate environment. Say they own the organization, but they're not there. That's true for anybody who invests in the stock market. I am a partial owner of Amazon. I probably own like 1/100 billionth of Amazon, but I do own Amazon stock. It's part of my index fund investments. So I don't go head up to Washington and just hang out with Jeff and say, hey, Jeff, how's my business going here? Okay, yeah, that's not the way it works. An absentee owner. Who are the agents? They're management. Management is the agents, the people who are in the organization on a day-to-day basis. Okay, so they're not the same people. The people who own the organization, the people who run the organization. And one thing that kind of is interesting about that is there is a big problem we refer to as information asymmetry with respect to this relationship. Who knows more about the way the organization is running? Those run the principals or the agents? Yeah, the agents. Yeah, the agents. The management's their daily basis. So this goes back to this idea of why accounting exists in the first place. Remember back in 220, you had to create those financial statements, and who are those financial statements created for? External stakeholders. Primarily, those external stakeholders are going to be people who own the organization. Now, there's other stakeholders as well, which auditing does relate to that. But the foundational answer to this is saying our original answer is these are the owners of the organization we're creating financial statements for. So the people who are running the organization, we try to get rid of this information asymmetry by creating these financial statements. That's one of those mechanisms that we do. We do annual or quarterly reporting and say, here's the information about the organization. So the people who own the organization don't have to be subject to every single detail of the day-to-day operations of the organization. Now, there's a few problems with this, okay? There's a few problems because information asymmetry exists. Also, there exists a problem with the fact that the two parties have what we call a conflict of interest, okay? So let's say you own an organization. What is your goal for your ownership? What do you want? You want to make money, okay? But let's clarify that, okay? Do you want to make as much money as you can right now and then leave the organization, or are you interested in the long-term wealth of the organization?
Right now, long-term.
Well, everybody at zero is interested in long-term wealth, okay? Okay, you day trader, you. All right, so long-term wealth, we can assume most organizations, like it's a Warren Buffett philosophy, want success is going to be over the long term. All right. What about management? Let's say that you're a temporary fixture of the organization. You're here for maybe 5 to 10 years. Are you concerned about the long-term prosperity of the organization? I mean, you should be, but is that what we've seen in a lot of companies? So that we go to Jeff Skilling and go to Enron, was he was just like, yeah, Enron's going to live forever. Yeah. Is that what he was doing? No, he was concerned about very, very short-term prospects. He wanted to be successful in the short term so he could make a lot of money and bail. Well, now he needs bail because he's in prison. See what I did there? Yeah. All right. The problem is that we've got an incentive alignment issue with that. Okay. So incentive alignment issues, we've got information that's not conveyed. And as we've seen in the past, even though we've got a financial statement mechanism that tries to alleviate the information asymmetry problem, the fact that managers know more about the organization and they've got different incentives means they can misrepresent the position of the organization. And we've seen that all throughout history. Okay, we've seen that all throughout history. Enron's a really easy one to go to because that's accountant's favorite one, but there was a much more recent one. It's Sam Bankman-Fried. Remember that company? Is FTX. Now, in Sam's defense, I don't think he knew what was going on, so you can't really blame him for that. But yeah, that one's kind of a fiasco. It's a lot different one. But there's a problem that the alignment creates incentives for people to do different things. So ultimately, we have to say, look, there's financial statement information. We want to make sure this financial statement information is correct. Hence, we have auditors, okay? Auditors come in and they're actually trying to determine what management is telling the external stakeholders, saying that information is correct. So managers create financial statements, okay? They create financial information for the stakeholders. Auditors jump in and they review that information. They look over that information and say, this is good or this is not good. That's ultimately the goal. We are what we call an incentive alignment mechanism, or we alleviate information asymmetry. Okay, we alleviate information asymmetry. There are other ways to remove incentive or to align incentives, and we can talk a little bit about those. But the simple truth is that incentive alignment is kind of what we're accomplishing here. So what do I mean by incentive alignment? Let's talk about this. Let's talk about this. So is there a way to align the incentives in this course? You guys want A's, right? Can we say that's the case? If I gave A's to everybody in this course, can we say that everybody would be happy? All right. If I gave everybody A's to everybody in this course, I'd be happy to do so. But what do I want in return? I want you guys to know auditing. Okay. I want you guys to know what I'm teaching you. I want everybody to walk out here and say, thank you very much, Dr. Bynes. I'll remember this forever, audit forever. Yeah, that's my goal. Yeah, not quite that extreme, I guess. Is there a way that we can align those incentives? Yes, good. I'll say, I'll give you an A if you show me that you understand auditing. okay? And so the way that we do that is through exams. That's actually what the front page of my exams looks like. So if you do well in the exams, and do well on the assignments in the course, you do everything I tell you to, I give you an A in the course. Seems like a pretty fair exchange, right? All right. What about the employer situation? The employer situation where the employees say, okay, look, we'll give you bags of money, all right, but we want something in return, okay? We want to make sure that you're qualified for the job that we're hiring for. How do you demonstrate your qualifications for a job?
License.
License?
Like,
Huh?
you know,
You're right. Like licensure is another way. What's another way that you demonstrate it? So something that you create. What? Resume. Yeah. Whoop, nope. Wrong one. Let's try this again. There we go. There's the resume. It's the first page of my vita right there. Okay. Which is really hard, really hard to read. And if you did read it, it's very boring because it's got the abstract for my dissertation on it. All right. So can we do some same thing as auditors? Yes, we can do. We can do what's called testing. We test the financial statements and then we issue a report. This is an old version of the report. The new report is much longer and much more tedious. But the same idea holds, is that we're trying to align the incentives of the people who are preparing the financial information and the people who use the financial information. As auditors, we test that information and we report on it. That's the goal. That's ultimately there it is. That's all you need to know about auditing for the rest of the semester. Let's get out of this heat. I wish that was the case, but unfortunately, I got a lot more to talk about. So the alignment occurs between those agents and principals, and we got the auditors down there at the bottom. And again, the alignment is basically saying, let's eliminate information asymmetry, or at least reduce information asymmetry. And let's make sure that what management says is accurate, because management's going to report on a lot of things. Now, I've isolated this to financial statements, but it's important to note that this can expand beyond just the financial statements by themselves. That's our primary focus area. In fact, what we're going to talk about in this course are financial statement audits. We're going to focus on the idea of financial statement audits, but that's a lot bigger picture than just looking at those financial statements themselves. One thing that we're going to revisit that you remember back from 367 are those things called internal controls. Auditors care a lot about internal controls as well. So we're going to talk about what those represent. Before we get there, though, let's go ahead and let's talk about some assertions, okay? Have you guys heard the term assertion before? So assertion basically means something that you're saying is true. You're making an expression, or you're implying something is true. With respect to this course, assertions mean something very specific. When I use the word assertion, I mean something very specific in that case. So in setting that up, let's go ahead and talk a little bit about some hypotheticals. All right, so what assertions are you making regarding this course? All right, you're going to get that A. That's your goal. You're going to get that A. What assertions are you making if you want that A?
I will test well.
That you test well. More broadly speaking, that you know the information. That I'm saying you need to learn this information. You're making the assertion, Dr. Barnes, I know this information. Okay. How do I test those assertions? I give you exams. Okay. I don't like giving exams, but I'll tell you right now, if I don't give exams, people don't learn the information. Isn't that weird? Yeah. So yeah, I give you the exams, you learn the information. That's kind of the goal. Okay. In the assertions you're making regarding your qualifications for the job, what assertions are you making there? That you can do the job that your employers hired you for? Usually, if you can't do that, your job doesn't last long. I know this from personal experience. Not me. This was actually somebody we hired at KPMG a long time ago. Said that she had this previous work in high-level data analytics. Sat her down with a very basic data analytics tool. She didn't know how to open it. So that was kind of odd. It was a little bit uncomfortable. Yeah. So you're making qualifications about it. So how are they going to test you on that? They check your resume, they check your references, they do all kinds of background checks to make sure that you are able to do what they tell you to do. So you're making assertions. Can we say that that's correct? Okay. And we're going to test those assertions. That's how we do things in auditing as well. So here's one of the most important things you will need to know in this course. You don't need to memorize it now, because trust me, when we get to chapter 5, you will get sick of this, okay? I will give these to you in chapter 5, and then every single chapter after that, you're going to hear me talk about it over and over and over and over again. And this is going to be the one thing you remember is management assertions. You may not remember what they are, because I've had prior students that I said, what are management assertions? They're like, I know there are a few of them. And I said, yes, there are. All right. So these are commonly referred to as audit assertions. And the vernacular in this course, there are several concepts that we use the word terms interchangeably. So if I say management assertions, or if I say audit assertions, those are the same thing. I'll even say sometimes assertions, okay? So assertions mean something very specific. There are three that I call the big three, the three most important ones, okay? The first of these is called completeness. Again, you can write these down. Don't worry too much about learning these yet. We will have plenty of time to learn them, trust me, okay? But this is just an introduction. Completeness basically says transaction took place, that it got recorded, okay? This would be a little bit like saying that somebody owes you money, that you actually recorded the transaction. Which if you made a sale and somebody owes you money on that sale, is it important to record that transaction? Yeah, it's a bad idea if you don't record that transaction. You're not going to get that money, okay? That's completeness. The opposite of completeness is what we call existence occurrence, okay? This is the other side. This is where we say we recorded something. Did it actually take place? So think about this from a business perspective. Are you a little bit concerned if your client records your sales transactions that never took place? Yes, we call that fraud, okay? We call that fraud when that happens. So we're concerned about that. The third of the big three is called valuation, allocation, accuracy. Note of this, the book will use one of these three terms. I will always just use all three. In fact, I shorten it down. I usually just call it VAA, okay? This basically means the transactions and events and balances, they're all valued properly, okay? We put them at the right amount. This one's fairly self-explanatory. And some of the additional ones, we have rights and obligations, that if we have assets that are on our books for a certain amount, that we have the right to claim those assets. So if we say we've got inventory in our warehouse, that we can actually say the inventory is ours. It doesn't belong to somebody else. We haven't sold that inventory. Obligations are the opposite. They say that if our liabilities are equity, that we have the obligation to recognize those on the balance sheet. Then we have two that are related: presentation and disclosure, and classification. Presentation relates to presenting information in the financial statements, saying that everything is presented properly and properly disclosed. Classification basically says that we've recorded it as it should be. It's properly classified. Classification often deals with whether or not assets or liabilities are properly classified as short-term versus long-term. These are related concepts, but you will notice I have PCAOB and ASB listed out. As we're going to find out, there are two categories of auditing standards. The first of these relates to public company auditing standards. These are sanctioned by what we call the Public Company Accounting Oversight Board, PCAOB, all right? This will be our focus in this course. We'll be talking a lot about the PCAOB. The PCAOB has 5 management assertions that they focus on. So when I say the 5 management assertions, that's those 4 on the left, plus this 5th one right over here. Classification, you'll notice this is ASB. This relates to private company auditing standards, which are the Auditing Standards Board, okay? That's a subset of the AICPA. Have you guys heard of the AICPA before? American Institute for Certified Public Accountants. They used to set the rules for everybody. Now they set the rules for private company audits only. So public company audits will be our focus, but we're going to talk about private company audits as well. The good news is we're just going to learn everything related to that with respect to assertions, even if they're not relevant to a particular type of audit. So for public company audits, we're concerned about presentation disclosure. For private company, we're concerned about classification. These are related concepts, though. They basically mean very similar things. We'll see the difference here in a little bit, or in a few weeks. Then we have something called cutoff, okay? Cutoff is related to completeness, except we're talking about a time period assumption. So we're trying to make sure, did something get recorded in the proper period? This becomes really problematic when we're talking about certain types of fraud. Companies will try to recognize revenues early or defer recognition of expenses. Do you guys remember the conservatism principle back from 220? Conservatism says delay recognition of revenue, accelerate recognition of expenses. Cutoff is trying to make sure that that takes place. Okay, I want to make sure that we do that properly. And then I threw this one up here. This is authorization. Now I'm going to tell you right now, authorization is not officially recognized as an assertion by either sanctioning body, by the PCAOB or by the ASB. So why did I have it up here? Because the textbook still holds on to it and says that it's an assertion. And so if I don't include it, then some of the questions in the textbook are going to look really, really weird. So it's not a real management assertion, but we're going to treat it as one for the perspective of this course. If you actually go into the textbook, it actually talks about it. It actually says, yeah, it's not a real management assertion, but we didn't want to get rid of it because it's important to talk about. The actual truth is this book that was originally published back in the 2000s when it was a management assertion, and they just haven't gotten rid of it because then they'd have to change a lot of the content. So that's just laziness on the publishers. One of my many gripes about this textbook, but it's still pretty good. All right, so management assertions. All right, so what do these actually represent? Well, we actually have different categories that we actually relate to. So we can actually have assertions about transactions and events, or we can have assertions about account balances, which sound like they're the same thing, but they're not. It's a very important distinction. Transactions and events usually deal with day-to-day operations. whereas account balances refer to reporting at a point in time, usually annually, but can be quarterly. So when we talk about day-to-day operations, we're looking at literally transactions and events. Talk about account balances, we're looking at the aggregation of all the transactions and events that took place. So the sum of all the detail. Now, why is this important? Well, the good news is the assertions don't change much depending on the classification, but the classification is important because we have to understand which assertions get used in which situation. Because certain types of testing can only be performed for certain categories of assertions. So let's think about those things called internal controls. Do you remember we talked about internal controls earlier? Do you think internal controls are more relevant to transactions and events or overall account balances? Very good, transactions and events, yeah. So they deal with the operations of the organization. So when I talk about the category of assertions related to transactions and events, I'm going to use those when I'm testing internal controls or when I'm testing substantive transactions, which we'll talk about what that means in a few weeks. When we get to account balances, we're no longer testing controls. We're only doing substantive testing of transactions. Now, I realize that makes no sense right now because we haven't talked about what any of that means, which is fine. What I want you to take away from this is that we're using the same assertions, but they mean something different depending on which category of transactions they're classified in, okay? So how are we going to conduct an audit? What are we going to do? Well, we're going to follow the process that we use in financial accounting. So management actually says what's happening. They implement internal controls as responses to risk. They conduct transactions. They accumulate these transactions and account balances to put them into financial statements. And then they distribute the financial statements to the users. You guys knew this already. You've done financial accounting. In fact, multiple financial accounting classes. I know this because financial accounting classes are a prerequisite for this course. If you're sitting in here and you haven't taken those financial accounting classes, you're a fraud. Yeah, but nobody here is a fraud. So yeah, except for maybe me. Yeah, so in order to actually conduct our financial statement audit, we have to set the terms of engagement between the auditor. The auditor is going to look at internal controls. They're going to look at the transactions. They're going to look at the account balances, and we're going to gather evidence about each of these, depending on what it is that we're trying to determine. Are we trying to determine if controls are effective? Are we trying to determine correct balances within the accounts? Are we trying to actually verify transactions and events? Are we trying to do all three? Depending on what it is we're trying to accomplish, then we're going to gather evidence on that, and we're going to test those assertions that we just talked about against our criteria. The good news is you already know what the criteria is. It's called GAAP, Generally Accepted Accounting Principles. Basically, we want to make sure that management is following the rules that are set by the Financial Accounting Standards Board. If they don't follow those rules, there is a problem. That is when we run into issues. We actually look at those rules and say, okay, we've tested the assertions. We know what the rules are. Did management follow its own rules? If the answer is yes, things are peachy. If the answer is no, we have to actually determine to what degree they managed to violate those rules. We actually communicate that information in what we call an audit report. And there's going to be different degrees of audit reports depending on how badly or how well management followed their own rules. We'll talk about that here in just a second, but let's actually talk about some underpinnings of financial statements. So these relates to the next three chapters we're going to talk about, chapters 3, 4, and 5 in order. So conceptual and procedural details of financial statement audit is built on three fundamental concepts. First of these is called materiality, which I'm not going to define these just yet because I'm going to define them in more detail in the coming slides. But materiality is just as it sounds. How big is it? How much does it matter? Second of these is called audit risk. Okay, audit risk basically is going to be like kind of a scientific type risk. Do you guys remember type 1 and type 2 risk from your science classes? Yeah, we're going to talk a little bit about more of those. Audit risk is a type 2 risk. We said something is fine when actually there's a problem. Type 1 risk is we said something's wrong when everything's fine. And then these actually affect the nature, extent, and timing. You can actually write down the letters NET because we'll be talking about those a lot during this course. The net of audit evidence to be gathered. Basically, if we think something is a problem, we have to gather more evidence. If we think something's less of a problem, we have to gather less evidence. That's what you need to know for now, but the actual association here becomes a little bit more detailed when we start talking about going into how far it is. All right. So what is an example of this? Okay, what do we mean by having to gather more evidence? Okay. Well, if it's something that we think that there's a very, very low chance of having a problem with, if we're trying to test a particular assertion and we think there's a very minimal chance of that assertion being wrong, we probably don't have to gather a lot of evidence. For example, I make the statement, I am an accountant. How much evidence do you think you need to, how much time do you think you need to spend gathering evidence on that statement? Probably not. There's a prevalence of evidence out there saying that Dr. Barnes is an accountant. One big thing, I have a PhD in accounting, okay? That's a big, strong piece of information that I'm an accountant. What if I make the statement, I am a superhero? I'm Batman. Yeah. Now, how much time would you have to spend gathering information to prove or disprove that? Now, honestly, to disprove it, it's probably not that hard. You know, it's like, look at him. He's an accountant. Yeah. But if I say the superhero and you're trying to prove that information, how difficult a task would that be? Probably a lot more challenging than saying I am an accountant, okay? So depending on the veracity of the statement, this is going to be a much more challenging task or a less challenging task. And so it really depends on how accurate or how much risk you see things associated with the statement versus the lower level of risk. Third category is audit evidence. This relates to management's financial statement assertions. So again, we gather evidence to test these assertions. So these are kind of our concepts. Again, these relate to our next 3 chapters. Materiality, chapter 3, audit risk is chapter 4, and audit is chapter 5. These are going to be really important for you to understand. If we get to the first exam and you're looking at this and said, I don't remember what Dr. Barnes was talking about when he said audit risk, you're in a really big world of hurt, okay? Because these are like the 3 most important concepts in this entire course. Let's go into a little bit more detail though, okay? So materiality, your favorite band, the Caden Brothers, not to be confused with the Jonas Brothers, is playing 2 dates in Kirksville. You've made the decision to skip auditing class to attend one of their performances. You have 2 possible choices. Missing a day will be working on an in-class assignment, which is worth 5 points, or missing a day that will be taking an exam worth 100 points, okay? So which one do you choose? Which class are you going to see? None, obviously. But if you only have those 2 dates and you have to skip auditing class, which why are the Caden Brothers performing at 1:30 in the afternoon? Yeah. Which one are you going to choose? Hey, why? It's worth less, okay? It's worth less. That's obvious, okay? It's a smaller amount of points. And you know how many points are worth this class is worth. It's right around 500 points, okay? 5 points, that's 1% of your grade. You can probably recover from that. 100 points, that is 20% of your grade. That's 2-letter grade drop. If you skip that one, you probably can't recover. But keep in mind, this is all relative. Okay, materiality is relative, and I'll explain what I mean here in just a second. What if there were 1 million points available in this class? Does your answer change in that situation? It's like, I'm watching both concerts, Dr. Barnes, I don't care. Yeah. Yeah. So it is based on the basis of what we're trying to evaluate here. So Supreme Court actually has a definition of this, and this is one the Financial Accounting Standards Board has adopted, okay? Information is material if omitting it or misstating it could influence decisions that users make on the basis of financial information on a specific reporting entity. So when we talk about materiality, the question is, what is the amount that would affect decision information by the user? So think about a company like Walmart, all right? If Walmart, if you read the financial statements and they said we had $1 million misstatement, do you, as a user of Walmart's financial statements, care about that? Probably not. $1 million is nothing to Walmart. They're probably just like, okay, well, whatever. Okay, that happens all the time. What if I said that about Greek Corner Euros? They had $1 million misstatement. Is that going to affect your decision usefulness? Yeah, you're going to say, do they make $1 million? Goodness gracious, the euros are delicious, but come on. Okay, so again, it is contextual. So will it actually affect decision usefulness? And it's important to note this is not a linear scale, okay? I'm not going to say every single person in this room has the same level of materiality. It's a little bit like saying, okay, I'm going to steal money from your wallet. At what point would you start getting really, really upset about it? Some of you might say, if you stole $5 from my wallet, I would report it, Dr. Barnes. Some of you would say, you touched my wallet, Dr. Barnes, and I'm screaming, okay? Which you probably should. I shouldn't be touching your wallet in the first place. But my point being is that you guys all have different levels of materiality. It's not what everybody would actually agree to, but what the aggregate average would be or aggregate median would be of that. All right. Next context. Okay. Audit risk. So the Audit Standards Report states that audit provides reasonable assurance that the financial statements do not contain material misstatement. Okay. Why don't we use the word absolute assurance? Why don't we use the term absolute assurance instead? Okay. So if we read the audit report, it says provides reasonable assurance the financial statements are free from material misstatements. Okay, that's the highest level assurance that we as auditors can provide. But why don't we say provides absolute assurance the financial statements are free from material misstatements? I mean, obviously, absolute assurance is stronger. Why don't we use that word, that phrase? Liability purposes. You're on the right track. Okay, can we actually provide absolute assurance? So I'm going to say, look, you better have absolute assurance that you're going to get 100% on this upcoming exam. Okay. What would it require for you to have absolute assurance to get 100%? Kyle's back there thinking I have to study for an hour. Yeah, but
The answer is beforehand.
yeah, you'd have to cheat. Yeah, but that was not a perspective I was looking at. Or it's like, yeah, but no, you'd have to basically sacrifice everything else that you were doing to study. If you studied from now, every single minute in this class now until you got to the exam, that would be close. Would that still be absolute assurance? Absolute assurance is impossible. Okay, we cannot achieve it. It's a guarantee that's not achievable. So that's why we say reasonable assurance. We're going to say, look, we're going to do enough work that we're reasonably certain of our answer, but we cannot achieve absolute certainty. So the phrase reasonable assurance implies that even when the auditor does a good job, there is some risk that a material misstatement could be presented in the financial statements and the auditor will fail to detect it. Now, there's two types of risks. There's the type 1 and type 2 risks that we talked about before. Type 1, the auditor says there's a problem when there's not. We don't care about that because it's very unlikely that's going to happen. One's really problematic, though, is when we say there is no problem, but we say that there isn't. Or sorry, there's no problem, but that there actually is. Okay, so we say everything is fine, but the financial statements are wrong. That is something that's occurred a lot in the past, and it's something we're very concerned about. Keep in mind that we have pressure from management to actually say that everything is fine, even if there's not. Management wants to have that opinion, that clean opinion. So that's what we call audit risk. The auditor expressly maintains mistakes or mistakenly expresses a clean opinion when the financial statements are materially misstated. That is our issue. We're very, very concerned about making sure that financial statements are correct, and we want to make sure that if they're not, that we express the correct opinion. Audit risk is just reflecting that particular idea. All right, finally, let's talk about evidence. So this is a lot of information to take in. So if I say, how would you gather evidence about the financial statements? You'd probably say, well, I'd look at the financial statements and all the supporting documentation. And I'd say, yeah, that's a really good idea. And that is one thing you could do, okay? That is inspection of records of documents, okay? Inspection of records of documents. But you'll notice there's a whole lot more information on this tab. There's a lot other ways that we can test that information. We can look at tangible assets. We can observe processes taking place. We can talk to people in the entity. We can actually send third-party requests, which we call confirmations. We can recalculate information. We can reperform controls and tasks, and we can perform analytical procedures. So even just looking beyond the accounting records, there's a lot of things we can do as auditors. This is probably not even a comprehensive list. This is the one from the book. If you actually are going to sit for the CPA exam, Becker gives you even more beyond this, okay? But I think this is a pretty good list. We're going to discuss these more in detail. What's important to note is by doing this, by gathering this evidence, we are testing specific situations under specific assertions. So we gain evidence, we gain support for whether or not the assertions are correct. An example of this, like one that's really, really broad, or sorry, really, really narrow, inspection of tangible assets is a very, very powerful test, but it only tests one assertion. So we can get a lot of information on a specific assertion, but we can't get any information on other assertions. Something like observation, on the hand, can test multiple assertions, but it's a very, very low reliability test. Because believe it or not, if people know that you're watching, they may change their behavior. Isn't that weird? Isn't that weird? Is that people change their behavior if they know you're watching? Yeah. It's like, yeah, if my mother was watching, I would not break in the refrigerator and steal chocolate. You know, that's not something I would do. But she's got out of the room, I'm just going to that refrigerator. Yeah. So that's kind of what we're concerned about. The observation is the changes in behavior. All right. Let's move on. The end product of an auditor's work is an opinion on whether or not the client's financial statements are free from material misstatement. What kind of auditor opinion or opinions can the auditor issue? There are 4 primary types of opinions, and they are characterized by a certain way the language is utilized. The first of these is called an unqualified opinion. On this side, next to unqualified, I also want you to write down the word unmodified. The reason for this is that this is the PCAOB term for a clean opinion. The ASB actually has a different term for their clean opinion. It's called unmodified. They mean exactly the same thing. Everything is fine, nothing is ruined, okay? Basically, we're saying that things are great. The financial statements are free from material misstatement. This is what we're shooting for. This is what the company is shooting for. This is what we auditors hope for. We want to have an unqualified or an unmodified opinion, or as we call it in the vernacular, when I say clean opinion, this is what I mean. That's kind of an idiom, okay? The word clean opinion. Clean opinion means that there's no problems, so that's why you hear me say clean opinion in this. Unqualified or unmodified, everything's good. What if everything's not good? Well, there's varying degrees of problems, okay? Second one is called a qualified opinion, predictably. Now, note, there's no change in vernacular for this. This is actually the same for both types, both PCAOB and ASB standards. So qualified opinions are basically characterized by two words, except for. Qualified opinions are characterized by two words, except for. So when you see a qualified opinion, they'll say everything is fine except for this. Except for this particular issue, the financial statements are free from material misstatement. There are two ways that a qualified opinion can arise. The first one we've already talked about. We've talked about it. It's called a departure from GAAP. It's when the management doesn't follow the rules of financial reporting. So if they break the rules of GAAP, we can issue a qualified opinion. The second one is what we call a scope limitation. And you're going to hear this word a lot, or this phrase a lot in this course, scope limitation. That means the auditor could not do their job. So I wanted to actually view inventory, the inventory count, to make sure that the inventory numbers are correct. But the inventory account is occurring in Alaska for some reason, and I can't travel there in the amount of time it would take me. So I was unable to perform look at the inventory count. That's something that limits the scope of the work that I'm trying to accomplish. It's a scope limitation. I could not do my job as the auditor. So these are relatively minor issues. What happens if there's a major issue? Then we have two specific report types for this, okay? First one is called an adverse opinion, okay? Adverse opinion basically means everything is a mess. This is a departure from GAAP that severely restricts the usability of the financial statements. We call that type of issue pervasive. Have you guys ever heard the term pervasive before? Pervasive means very, very big. If we have a pervasive departure from GAAP, it basically means the financial statements are materially misstated. They are not free from material misstatement. So massive departure from GAAP, that's adverse opinion. The fourth one, this is a disclaimer of opinion, as a good old Brick would say, I have no idea what's going on. This situation basically means that there's a pervasive scope limitation. We could not do our job, so we cannot issue an opinion. That's basically it. We can't do our job as auditors. We have no opinion. There is one other situation that this may arise, and it's very incremental, incidental. It only occurs under private company audits and very, very rarely. It's called a lack of independence. If you're not independent from your client, you can't issue an opinion. But that's a rare corner case. The one that we're mostly concerned about is a pervasive scope limitation. So just to clarify something really quick here, you heard me say on this one right here, qualified, I said that this is a departure from GAAP or a scope limitation. These would be material items, something that's enough to affect the decision of users, but not big enough to be considered pervasive. When I use the word pervasive, I'm talking about these extreme circumstances, adverse opinion and disclaimer of opinion. We'll talk about this more after the first exam. When we get into the opinions, we start talking in chapter 18. We'll have a lot of detail about this. For right now, just make sure you understand the very basic differences between these types of reports. So where are we going from here? Well, on Friday, we're going to talk about chapter 3, the first part. We're going to get into a little bit of detail about client acceptance, continuance, preliminary engagement activities, and setting the audit plan. That's going to continue on through chapters 3, 4, and 5. Then we'll have an exam. Hooray! And then we'll take our exam. We'll talk more about internal control testing. We'll do some sampling stuff. We're going to jump actually to chapters 17 and 18 before the second exam. Then our last part of this course is going to be business processes in chapters 10 through 16. All right. So a few more things I want to talk about. I'm running out of time. I always do for this course. Is the concept of what auditing means with the scale from the scale of assurance. Has anybody had an internship yet? Okay. Did anybody encounter the term assurance during your internship, saying I'm part of the assurance practice, and then you found out that's auditing? So assurance represents a broader scale than auditing. Auditing is a form of assurance. Assurance is a much more broad context. It actually can be depicted by these three ovals. Assurance is very, very broad. Attest is basically like an audit, except it's more general. It doesn't have to necessarily be auditing financial statements. It can be auditing pieces of financial statements or auditing or looking at compliance. Auditing is a very specific task. We talk about auditing, we're talking about financial statement and internal control auditing. So this exists as part of the greater whole. So we'll talk a little bit more about that. I think that's going to occur before the second exam. We'll talk about that, of what auditing's role is within this context of attestation and assurance. They are related, but not necessarily the same thing. All right, my favorite thing. So philosophical thoughts. Is it possible to do well on the exam without knowing the material covered on the exam? What do you guys think? I think it is. One, you could cheat, steal the answers like Naughty said. Yeah. Is it possible that you could still do well even if you don't cheat? Could you like get really, really lucky and circle the right multiple choice answers? Okay. And then just kind of luck into the fact that you remember some of the things I asked about? Yeah, it's possible. Okay. All right. Are there reasons why the most competent qualified candidate for a job might not get hired? Yeah, they could lie on their resume. That certainly can be problematic. So the question is, do the ends justify the means? If you get the result that you're looking for, does it matter how you got that result? Maybe that's a philosophical. Don't challenge me like this, Dr. Barnes. This is a Wednesday. Yeah. Okay. So that's an interesting question. And the reason this is important is because up until 2002, we basically, financial statement auditing was basically saying, we don't care what the process used to get to the end result is. We just want to make sure the final results are correct. Okay. That was basically what we did up there. And then all of a sudden, some big things happened in financial accounting that changed our perspective on that. Like Enron, WorldCom, the collapse of Anderson. So everybody started questioning, why aren't we looking more at the process? So an interesting question for you, interesting query, okay? Let's assume that you go to your favorite restaurant. I'm going to say Seabreeze. Has anybody been to Seabreeze? You're going to hear me talk about Seabreeze a lot. It's my favorite restaurant to go to. I always get the cheeseburger there, okay? Now, I want you to know I've never had a bad experience at Seabreeze, okay? I want to throw this out here, but this is my example. So let's say I'm sitting there waiting for my cheeseburger, okay? I'm waiting to get my cheeseburger at Seabreeze, and I see them prepping it, and they're getting ready to prep it. And I know that the Seabreeze cheeseburger is going to be delicious because I've had it probably 100 times by now. It's my favorite thing to eat when I'm here in Kirksville, in the Kirksville area. All right. So I really want that delicious cheeseburger. When we say that's a laudable goal. Okay, so then we go move, and I see them in the back, and they're creating my cheeseburger, and they're putting the finishing touches on it. And the person who's preparing it sneezes on it. Mm-hmm. Let me ask you a question. Is that cheeseburger probably still delicious? Do you think I care anymore about whether it's delicious?
No.
Okay, can we say that the process does matter? It doesn't matter the end results anymore. It's like, I want a delicious cheeseburger, but am I going to eat that cheeseburger if I know it's been sneezed on? Now, to clarify, to my knowledge, I've never eaten a cheeseburger that's been sneezed on. It's the Seabreeze, okay? Okay, as one of my former students says, it's not a cheeseburger anymore, it's a sneeze burger. You know, so yeah, that being said, we can look at this situation and say, all right, process does matter. And that's why we have the situation with internal controls. So like I said, audits before 2002, financial statements, we're just focusing on the financial statement, not really concerned about what the process was. So testing of controls was optional and briefly an afterthought. Nowadays, that's not true. We are concerned about the process, which is why we're concerned about internal controls. The idea being is the financial statement should be able to know how companies achieve their results, not just what those results were. So we're going to spend some time talking about internal controls as well. The idea being is that we are concerned about the end result, but we're also concerned about the process used to achieve that result, which is definitely a more holistic approach to financial statements and auditing as a whole. All right, a few more things to kind of wrap up, okay? So a few auditors we're going to be concerned with. This is going to be the primary focus of external auditors, but there are different types of auditors within our occupation. Internal auditors, government auditors, forensic auditors. I used to be a forensic auditor, so I'm really proud of that. Okay, yeah. So what types of other audit services are there? Well, we've got internal control audits. These are related to financial statement audits, and they're required by the PCAOB, but they're not the same thing. Financial statement audits, again, focus on end results, the reporting at the end of the audit. Internal controls focus on the process. We're going to talk about these jointly. We're going to consider them together because I think it's important to not just consider what the end result is, but also the process used to achieve those results. Compliance audits. When you see the word compliance, you should think two words: laws and regulations. Do they follow the rules of the business that they're in? Operational audits. This would where Dr. Otero would actually listen to what I was talking about, because this is more about the operations, the day-to-day work of the organization, not even accounting related. We can talk about procedures, processes, whatever the rules are that for the business we're operating day to day. And forensic audits, those are usually after the fact. These are trying to make sure that we have fraud detection mechanisms in place, and that if a fraud takes place, how do they resolve it? They can also engage in other types of attestation and assurance services and some in non-audit services, but it's important to note that most non-audit services, especially for public companies, are prohibited by the SEC. This as a result of the Sarbanes-Oxley Act of 2002. We don't want auditors doing things that could impair their independence. That's a hard statement to make. Could impair their independence, because if we know anything about the Enron situation, Anderson was taking about half of their fees from non-audit services. And so when they said, look, we're going to have to issue an adverse audit opinion, they said, well, that'd be a shame for you to lose $25 million in non-audit fees. It's like, oh, did we say adverse? We meant unqualified audit opinion. That's why they don't allow that anymore. All right, speaking of those right there, okay, audit profession used to be self-regulated, but then these things happen. There was a lot of them, actually. I say Enron and WorldCom, but there were a whole lot more. This is just some of the most well-known ones. But that resulted in this thing right there, which I'm sure you're familiar with, the Sarbanes-Oxley Act of 2002. Sarbanes-Oxley Act is mostly about financial reporting for organizations, but it did have one very, very specific effect relating to auditing, and that's what's going to be in the lower right-hand corner, the Public Company Accounting Oversight Board. This is the body that's responsible for setting the standards for public company audits in the United States. With respect to audit responsibilities, due professional care requires that an auditor exercise professional skepticism. Add to the questions of questioning mind and a critical assessment of auditors. So when I say professional skepticism in this course, basically, you do not want to take anything that's given to you at face value. You should question everything that's asked. As we're going to find out as we move forward in this course, certain types of information that we gather as auditors, we can actually say this is good, reliable evidence. Other types of information we're going to find, we're going to have to gain corroborating evidence because we can't take the original evidence at face value. Remember, I was talking about observations earlier, and I said people change their behavior when they're being observed. When we do an observation in auditing, we often have to get support for that evidence because we know people will act differently if they know an auditor is watching. So we have to corroborate that information. That's part of this professional skepticism that we exhibit as auditors. In addition, regulatory bodies, auditors accountable to the governing body of organization. So you guys have heard the term corporate governance before. We're very concerned about certain types of corporate governance in this particular course, okay? You guys know the board of directors, the ones that represent the stockholders of the organization. Who do we report to? Auditors, though? Hopefully, it's going to be what we call the audit committee, which is a subset of the board of directors. Audit committee composition has very specific criteria that we have to follow, particularly for public companies. We'll talk about that more, I think, on Friday. I believe that's when we're going to talk about it. But it's important to note, this is our corporate governance mechanism. These are the people that we say, if there's a problem in the organization, who we report to and make sure that they know about it. Our business processes. This is interesting because it's going to loosely follow what you guys learned in AIS. We are going to expand upon it because in AIS, we talked about revenue, we talked about procurement, we talked about inventory, we talked about human resources. We're also going to talk about financing, which is basically everything on the balance sheet that's not current, okay? We're going to talk about long-term assets, long-term debt, equity. We're also going to talk a little bit about the income statement. This is going to be a blitz of 3 weeks near the end of the semester. There's going to be a lot of material to cover, but you guys will have the foundation to know actually how to do this testing at that point. Final thing we want to talk about is the ethics and the professional code of conduct. So you guys have heard the term ethics before. And I'd say, how many people in this room think they're ethical? Everybody will raise their hand, okay? Now, ethics are interesting because I don't think they can exist in a vacuum. I think it's very, very conditional on the situation that's important or relevant. As we're going to see in chapter 4, ethics tend to be very flexible when given certain stimulus. And we're going to start talking about fraud and what situations exist for fraud to occur. And that's where ethics comes in. We also have some concerns about professionalism. Professionalism are related to ethics, but expands beyond that. Beyond just being ethical as an auditor, we also need to know that we have to act in certain ways and we have to do certain things as required by our standards, our criteria. The ACCT has something called the Code of Professional Conduct that actually establishes guidance for acceptable behavior auditors, contains principles, rules, and interpretations. One of the biggest ones you need to know is about this thing called independence. And basically independence means is that you cannot have a relationship with the client that you're doing an audit with, Okay, whether that be a financial relationship, like you own stock in the company, or whether that be an indirect relationship, like somebody that's in your family is works for that organization. The independence rules are really, really important, and independence violations tend to be really problematic when they occur. So we'll get a lot more of that when we start talking about the code of professional conduct, which I believe is after the second exam. It's going to be our exam review. I know that was a lot of information to absorb. The good news is that it's going to exist forever on YouTube. Okay, so if you missed any part of it, you can refer to that. But I wanted to make sure we got that all in. Homework due on Friday, idea due on Friday. We'll start chapter 3 on Friday. A lot to consider. See you guys then.